To claim that Indian economy is doing well and Indian markets will continue to do well, I think it's an easy claim now. But 20 years ago, to identify the potential that India and Indian markets could reach where they are was a rarity. And my guest on the show is one of those rare breeds who 20 years ago had identified that. Actually, more than 25 years ago, I had identified that. He's an original thinker. And if there is one interaction everybody really looks forward to, including me, is to understand Ramesh Damani's outlook for the coming year, for India, and what is the original thinker thinking in terms of mega trends. I mean, the word mega trends, before it was coined, Ramesh Damani actually started adapting that in terms of identifying IT, content companies, railways. How can we forget that famous call? So I'm really excited to host him on this year special. What a delight to have you, Nitina. Thank you for joining us.
Nikunj, it's always a pleasure to be on with you, and thank you so much for the very kind words. And I will say that learn to be bullish in India, I learned from a common friend, Rakesh Jhunjhunwala, and my mentor, R.K. Damani. They're the ones who taught me that India is a growth country. It's so populated and so... the only upside is now, the downside is that there is only upside. So I owe a lot of debt to those two people at least.
But to be fair, Ramesh, you've always identified mega trends. And before world started using the word mega trends, you started actually practicing the whole thesis of looking at the big picture and then identifying companies within that.
Yeah, absolutely right, Nikunj. I tried to do that. I think we kind of, when I came back in the late 80s to India and the mega trend was cement shares, it was actually morphed by what was called the liberalization trend that was taking place in India. So after that, I realized the big money is made in the big swing, and you need to identify the big swing. So we were very lucky we got the 2000 technology trend right, and then I tried to follow each bull market and try and spot the leadership in this bull market. And I've been at somewhat of a thought process trying to figure out how do I label this bull market that started, how do you label this bull market? And I finally had a, what you call eponymous moment, which says that the label would have called the growth of the great Indian middle class. I think that's going to be the great story. There's a new book out which I'd recommend. I haven't read yet, but I've ordered, by Homi Kharas, called The Middle Class. And a lot of my ideas are from there. And he says that it's the middle class that started in England in the 18th, 19th century that is shaping our world today. And he says that out of a population of about 8 billion, 4 to 5 billion are now in the middle class. And the maximum number of middle class are coming from people like India rather than even from places like America. So that's going to be a major trend, because the middle class is, someone defined roughly having a PPP, purchasing power parity, of about $12 per day, which is significantly above the poverty level of $2 a day. Which means at that point they can save, they can invest, educate, travel, do a number of things. And what we are seeing perhaps in India is, the beginning of this hockey stick curve. As our per capita has gone over $2,500, the middle class expanded quite handsomely. And they are now demanding action on things from climate change to travel to better education to better living standards. So I think that'll be, as you correctly pointed out, the mega trend that is not only shaping this bull market, but also the society around us.
Okay. What is right and wrong in this market? We can argue both ways. What is your assessment?
Well, I think there's much to be right in this market. I think the last few days we've seen a significant fall in the market. And I think we've added, if I'm not mistaken, about 13 crore demat accounts in India, a majority which have come in the last 3 years. And all of them have been uniformly optimistic, which is good. But they're getting a lesson to understand, Exhibit A in the market, the difference between what I call risk and volatility. Risk is the choice of permanent loss of capital, which is very dangerous, and you don't want to be in that situation. Volatility is what happened yesterday and what happened the day before yesterday, and what will keep on happening in the markets. That market's correct. The next 2,000 points on the Sensex can be up and down. Nobody knows what's going to happen. Maybe an astrologer can say what will happen. But my strong feeling is that the next 20,000 points on the Sensex are higher because of the unfolding demographics, digitization, and democracy that's taken root in India. So I feel that there's a lot that's going on right with this market. What is going wrong in the market? Always a bull market like this will lead to excesses, will lead to overstretched valuation, will lead to unnecessary confidence, will lead to perhaps sometimes regulatory changes that are important, or regulation changes that are important being pushed aside because the market is doing so well. So we hope those mistakes don't happen. But there's a lot to be thankful and a lot to be looking forward to be optimistic over the next few years than rather be pessimistic.
The hallmark this year has been the smaller you've gone, the better the gains have been. From SME to small cap and mid cap and large cap. Do you think you need to be careful and watchful in the SME and the small cap space now?
Well, the way I look at it is that what was unpopular, what was unloved, what was unacknowledged has done well, which makes classic sense for a new bull market. You want new leadership, and so it has to come from extreme unpopularity. We've always known that, and that always happens. Is there a bubble sort of happening in the SME segment or in the option segment? Probably. I would be very careful in that segment. The kind of volumes that trade place in the option is beyond my understanding. The kind of froth we see sometimes in the SME market is beyond that. But broadly, a well-managed company, whether it's a small cap or large cap, is still a good investment opportunity, and I would remain invested in them. I would be very careful of the bubble territories, things in, say, the SME or in the option market. But otherwise, I think I'm pretty much okay with the market.
How are you approaching this market? Fully invested?
Yeah, I'm fully invested. I barely have any cash, which is rare for me. Typically, I go in with 5-10% cash into a bull market. But I think as I've aged and matured, I've been more confident of putting all the money on the table and let the risk come where it will. I feel there's good reason for optimism, and I feel that one of the sectors that I called this time was, of course, the public sector stocks, Nikunj, and they've had a brilliant run out there. And I think we need to give credit to the Modi government. The public sector was one of the dregs on the Indian economy. We all were talked about privatizing this economy, but they've turned this around. If you look at Meet the People in Japan, they're really on top of the game. For the first time, they're doing an OFS, and the prices go sharply higher after the OFS. So the fall is very temporary in those prices. And I think the debate that at least we used to have that they should be privatized or value will not be unlocked has now receded. I think we are fine if these companies are so well managed. And I think one thing very important that people missed in the stock market was that A, the government would use these public sector units as the blunt edge for capital expansion, and B, that they were telling them that you have to pay 30% out as dividends. So you go back 2-3 years, you're getting these companies on today's earnings and be 7-8% yield, which is extraordinary bonanza for investors who got in early. So, I think it's been a good place, and I'm very clear, including after what the Prime Minister said in Parliament. I mean, I'm sure you noticed that. They basically, the Prime Minister of India going on the floor, the well of Parliament and saying, a bullish case of public sector stocks. When did that happen? It's never happened. So we were ecstatic when the Prime Minister did that. I think it was in mid-August sometime.
Yes.
So I think my personal feeling is that the leadership, as they keep telling, is very much intact with the public sector stocks. They probably have a largish way to go still, because typically if you see in the bull market leadership, the stocks go up 10x, 20x after some point. So I would remain invested in good quality businesses.
I mean, the market cap of PSUs, we were looking at the data yesterday. From 2021, January 2021, the aggregate market cap for PSUs, including LIC and some new IPOs, is up 3x. That's the aggregate market cap.
I know, it's been a phenomenal run, and plus you got so much dividend out of it. I mean, you were getting these stocks basically at 4 or 5% yield, and with the certainty of an order book. It's not that the order books were speculative. We knew the order books for the next 5 years. So, it was, I think there was a whole debate which was, I think, wrongly conceived in the stock market last year, was that you buy quality at any price, and of course that's a misleading. You can't buy quality at any price. You cannot, there's a price that you pay will reduce your investment returns without doubt. And I think the people who stuck to finding value investing and trying to find value, irrespective of the PSU, small cap, large caps, it didn't matter. I think did well. So if you look at some of the exchanges, the major exchanges remained stable, but the unloved exchanges went up. The FMCG and the private banks didn't do well. The PSU banks did so well. So the market, took note of the cheapness of those particular sectors and rewarded those who bet on that sector very handsomely. And I've been lucky in that.
Within that, you identified railways. You've gone on record and you've said that you bought into the railway PSU basket, less of defense and more of railways.
Not true. Actually, my first bet was on defense, and then second was on railways.
Okay. So but you bought both?
I bought both, and I bought both with a lot of, I wouldn't say with the conviction I have now, but I just felt that they were too cheap. And I bought in fact, all the defense companies. I think some of them are extraordinary businesses and they continue to do well. And what's happened, Nikunj, is that we've gone from importing a lot of the stuff to making the stuff ourselves. And now we're exporting it. Look at the number of orders that, say, a company like Bharat Dynamics is getting or Hindustan Aeronautics is getting. It's extraordinary, the shift that has taken place. So I think if you ask me within the PSU sector, where is the leadership? I would say it's in the defense.
And you think that one should look at these stocks barring the volatility which could happen 10, 15, 20%, nobody knows. But as a leadership sector, you think PSUs as a bracket and within the defense and railways could be subparts?
I think so, and I mean, just to point out, there's a lot of poo-pahing about the PSUs over many years, and I just, wish your people who come on the show and, speak poorly of them would certainly see a company like Bharat Electronics, which I own and I'm not recommending in any way or form, other than educating the public about it. I mean, we bought the stock maybe in the early 2000 at, 300 crores market cap. It's 1,30,000 crores right now. The dividends itself are compounded at some 18-20%, something silly. So they've delivered some superior returns and they never dilute the equity. That is the most important thing I find. They've never diluted the equity in the 30 years they've been listed. They've never diluted the equity. Which Indian companies can you say haven't done that? Even Infosys diluted the equity multiple times. So extraordinary business done extraordinarily well. So I think some of the criticism has been misplaced. I think people who criticize them lumped them all together without trying to do what a stock picker should do or good value investors do, is judge each individual company on its merit. I think paying the price for that.
Why do you think these swings happen? I mean, if the market cap was so cheap, if it was a defense, government-backed business, dividend yield was so strong, the same thing happened to, let's say, PFC, REC. Why do markets ignore them?
It's a case of throwing the baby out with the bathwater. A lot of what is called herd mentality. I think sometime in the mid-2000, the mantra became very popular in the stock market, quality at any price. We want good capital allocation. There's some very well-known, one author I met recently called Pulak Prasad, and I respect him for it. He's done a fabulous job.
The book is fantastic, actually.
Yeah, book is fantastic from Darwin, what I learned from Darwin. But he made the statement, he said, I'll never invest in the public sector. But then he was honest to say that I want to invest in a MNC also, because both are very poor capital allocators.
Even conglomerates. He said, I've never bought Tatas or Birlas.
So I appreciate that. At least he had the intellectual honesty to say that I don't want to go to a capital allocator is bad. MNCs will also not do it in your best interest. I really appreciate that. But most people just want to throw the baby out of the bathwater because, we made a lot of money in the first round of the PA. So we were familiar with these companies, we understood valuations out there. And there was a period where we didn't make any money from them. But again, it's come back. So the market has to have the cyclicality and up and down trajectory that goes through. I think people who just said, in 2000 I only invest in tech in India, or people said I only invest in high quality business, pay the price. The market is not a place for the arrogant, it's a place for the humble.
So the money in markets, mean reversion is the biggest truism, they always say that. Excesses always get created on the upside, on the downside. Where do you think markets are mispricing growth on the upside, that they're pricing a cherry consensus, and where do you think they're still ignoring the potential of the business or the value of the company?
It's a very difficult question. I don't know all that because I'm a stock picker. I try to look bottom. Having said that, my first question is, would I want to remain fully invested? A correction started, maybe it's coming, maybe right on there. I think yes, I do. I mean, I don't see any signs that I normally would see in a top. We do see some signs, the reckless capital expansion, the IPs, the response to public issues, something out there. But for the first time, we're also getting, 3 crore new investors coming in. Every morning the market opens, 1,500 crores is ready, waiting to be invested. So that is a sea change that is happening. So some of the tops that we see in the market in terms of over-leveraged companies or too much debt or, too shaky corporate earnings, I don't see that yet. So I'm willing to tell you that what we are witnessing now is volatility, and that is nature of the market. I think Charlie Mungo recently passed away and was asked the same question. He said, in his lifetime of 40, 50 years of being with Berkshire Hathaway corrected 3 times of 50% each, and it didn't matter a whit to him because he said that's the nature of the market. We can't deal with it. You're not going to make money in life. Okay, so volatility is what comes with the market. Risk is what I said is the chance that I can permanently lose capital, that I buy a business that goes bust. There have been a lot of businesses that go and bust. In India also, on the 2000, the tech boom, I can rattle off names. I don't want to embarrass promoters, but the business is gone lost. So you want to avoid that kind of situation for any time in the portfolio. And that can happen even in a good market, that the stocks can actually go bust. So you don't want to get into that. A lot of people do option trading, which is a zero-sum game. You probably want to scale down on that because it might be easy money, but when you lose, you can lose almost your entire fortune in that. So I would be very careful of that. But there are very good high-quality businesses in India, which I told you, whether it was the public sector stocks, the BPO businesses, the IMEC corridors that we're talking about, which will generate returns and do well for the customers over many, many years to come. And if you are young in India and you're looking at the next 30 years, you need to invest. I mean, someone asked me what is the best time to invest in India. I told them, in my opinion, the best time to invest was July 24th, 1991, which is the day Manmohan Singh gave the budget. The index was 1400. The census was, believe it or not, 1400 out there. And that day the cards were open. We knew that India was going to change and go to a better place. And subsequent events have proved it completely. The next best time to invest is today. I mean, if you haven't invested in India, you've got to start doing it now. I mean, when are you going to do it? And look at it from a period of 5, 10, 20-year periods. Don't look at it from the next 5 days, which, as I said, could be extremely volatile and you could lose a lot of money out there. But if you keep the faith, buy a high-quality business with good cash flows, you're going to come out ahead in this business.
Okay, I'll sound very repetitive with this one, but it's important that we just get your views again for the benefit of our viewers. If you weigh prices and risk and the market dynamics, sliver of the market may be expensive, which always is the case, but by and large you think the market is in a good, if you do a health checkup, the diagnosis of the market, you don't think there is a bubble or there is a mania in the market. One should remain fully invested.
Absolutely not. I mean,
I'm asking point blank.
Yeah, I mean, point blank, and I know I can be wrong with these kind of things. You don't know, markets are, lived forward but understood backwards. So you do that. But all my predisposition tells me remain invested, don't get scared by the volatility. And I haven't been for 30 years. I've always remained almost fully invested in Indian markets. So don't get scared by the volatility. The best is yet to come. I think, maybe India can't double in 3 years, maybe double in 4 years' time. But, it's still, the best place for a young Indian to be. I'm not a young Indian anymore. I'm reaching senior citizen level. But for a young Indian, you're 30, 35 years starting out, where are you going to put the money? I mean, you can't put in gold or cryptocurrency. It's a dud's game to do it. It's a mug's game, in my opinion, to do it. You need to put in equity, which generates some returns for you, gives you some dividend, and allows you to build your wealth, just like my generation built the wealth. As I told you, in 1991, when we started, the index was 1,500. It's closer to 75,000 now. Look at the journey that's taking place. You made 30, 40x on the index. Imagine if you pick stocks, how well you must have done during that period. So I think, given the sweet spot that India is in terms of its democracy, in terms of its demographics, in terms of digitization that is helping, and the growing middle class in India. There's a growing middle class. Maybe 500 million people will be in the Indian middle class in the next by 2030. Extraordinary development taking place, and we're going to witness what a lot of economists call the J-curve curve. Once India's economy per capita goes over $2,500, $3,000 per cap. And in that, there'll be wide dispersion of people earning 10,000, 15,000. The average is 3,000, but there are a lot of people above that number. And that's going to power growth for a number of years to come. Demographically, as you know, we are the best positioned country in the world. I think China's population is projected to go over the next 30, 40, 50 years, maybe from 1.4 billion to 800 million. That's the kind of demographic disaster Korea, Japan, Italy, China are facing. India's population is still growing and still young. So the next 20, 30 years, we don't have a problem.
Okay. So I'm just going to borrow the term which you just coined, the middle class bull market or the middle Indian income bull market. What is the best way to participate in that? Because if I look at that aspirational India, which is young and under 25, they will travel more. They will consume better products. The value curve will move towards premiumization. So should one really build an aspirational portfolio of what Indian middle class will consume and just sit on it for next 5, 7 years?
Well, again, it's always a reference to a price. I think someone pointed out that one of the best consumer companies in India, Lever, hasn't given a return for 2 years or 3 years. It's probably given you, flattish returns for 3, 4 years. Before that, it went up 10x. So, it depends on the price. The price is, I pay a lot of importance to the price, Nikunj, because, to me, it's, if you ask me what I think about a company, the first question I'll always ask is, what is the market cap of the company? Because I want to evaluate how the market is valuing that business, So I would pay a lot of attention to the price, but these are sweet spots that you need to be invested in, depending on, again, the availability of price or whatever. Like I have kept Lever, for example, in my portfolio over 25 years. I mean, though it hasn't performed over 3 years, it doesn't bother me a bit. Because I know that the compounding over 25 years will be okay. It may not be over 3 years or so. I want to keep participating in those kind of businesses. So I'm happy to do that. But we move our assets around in other stocks in the meantime, sometimes in the public sector, sometimes in the KPO business, sometimes in the China Plus One strategy, sometimes in the IMECC, because where we find value. So in a portfolio construct, you obviously want, as you say, those India names that you feel that you want to own for the next 10, 20 years, but may not give you returns for the next 1 or 2. But you also want to own the stars of tomorrow, which you feel the businesses that will do well. So I think if trade goes well, this businesses that support the IMEC corridor will do very well.
When you say China plus one, there are again zillions of ways in which you can play. Literally zillions of ways now. There is EMS, there is chemical manufacturing, even textile as a sector is coming back. What to your mind is your best way to bet on China plus one?
We found 2 companies. I mean, as you say, there are many ways to skin the cat. So I'm not saying I know all the ways to skin the cat. But I feel there's a definite movement towards, amazingly enough, I mean, you grew up with China for the first time, you know, you're in India and China's going to the background, and China is actually destroying wealth by its fight against entrepreneurs and capitalism, and India is promoting entrepreneurs and capitalism, which is great. We found an auto ancillary company, which in Gujarat, which is on the edge of globalization. I mean, the kind of cash flow the company's been able to generate, and also the global opportunity, because people want a manufacturing base in India. So that opportunity will come over the next 2-3 years. We'll just sit and watch that place. So that seems like a good place out there. There's a small engineering company we found in Indore, of all places, you know, which seems to be, again, benefiting from climate change, benefit from, you know, nearshoring to India. So, I mean, there are lots of ways you can probably find a place. But as you correctly pointed out earlier, that this is a theme that you want to latch on to. You know, it could be in drugs, it could be in chemicals, it could be in engineering, it could be in services, I'm not sure. But you want to see things that, oh, the global market will move from China to India. I think that's inevitable, because they cannot trust one supplier, which is a communist and in an adversarial position anymore. So you want to move it to India. But having said that, India's tech service, so BPO, will continue to outperform dramatically, because the cost of real estate is so cheap in India. Labor is so cheap. You cannot find labor in America at even $15, $20 an hour. So you're getting cheap out here. So the BPO space in particular will probably do very well.
Have you put your mind to what could be the AI disruptive impact on the traditional IT services model?
You know, I'm pondering my head around it, Nikunj. It's very hard to grasp what it will be. I mean, if you listen to what Bill Gates say and a few other people say, it is pretty, it's a train coming down you. But I have not been able to fully discount it yet, or fully be conversant with what happened to my tech stocks. Will the employment shrink because AI will do the code for these people? Or, you know, will it expand because there'll be more need for people to do this? I'm not really sure yet. I have my basic tech investments still in place. I haven't moved them around much. But what the impact of AI is going to be is something that maybe in the next 5-10 years will be clear, is not clear to me right now.
You know, purists would always say that we would buy pure IT. 2000, top 4 IT companies were TCS, Infosys, Wipro, HCL Tech. 2023, they're still the top 4 companies. But where you hunt, where you like to fish, you like to typically fish in the $1 billion to $2 billion pond, and you've been shopping there. So within those niche IT companies, whether it is product or whether it is SaaS, where are you shopping?
Well, I got a few of them wrong, to be honest with you. There was one product company in cybersecurity that we were very bullish upon. That didn't work out. I mean, to be honest, that, you know, we bought at the top, sold at the bottom. Now it's come back all the way. But, you know, we got out of it at a loss. So, you know, to be honest and perfectly candid, it's a tough business, as I've told you, it's very humbling. And I think since 2000, I was very enamored to find a product-based company out of India, you know, and that was in cybersecurity, was all the more helpful to me. But he just couldn't scale up the business, and he could not address the global market. So, you know, it didn't work out. So, you know, it remains a very humbling place. I mean, I'm not by any means saying that. And I think, thankfully, after 2000, even I broadened my search out to include a few other companies in the consumer sector, like we got McDowell's or whatever else, and now in the public sector units. So I think it helps to keep an open mind and look for value, and not say that I'm only going to find value in tech. And that is what Charlie Munger used to say, that if you are, you know, like a man with a hammer, he's going to think everything's a nail. I don't want to do that. I want to, you know, 60 years plus in life have taught me to be flexible and to think of values in different ways. And, you know, hopefully each bull market has matured me, and, you know, I'm no longer stuck in the ways I was in 2000.
You know, we've always focused on what is a smart investor buying. We never focus on when do they sell and why do they sell. So the decision of buying can be templated with a model, it could be templated with a theorem, it could be templated with varieties of you know, thought process that you have. But the decision to sell, I think, is the difficult one. So the decision to sell, how do you arrive at that, and what's your process?
Well, you know, I've actually also tried to graduate myself over the last 30 years or so. I would start with, all the stupid things that we do in the last year, double your money, sell it, you get half for free and all that is
You don't do all that now.
I've grown up. I don't do all that. That used to be, self-defeating. Once I had influence, I realized the stock cannot go up double, can triple, can go up 10x, 100x, 200x. Why would you want to sell it just because it's doubled? It's a pretty silly idea, and then look for a new business out there. So I learned that very early on in life. I didn't want to do that, and I hold out there. And increasingly in the continuum of learning, I've tried to try to be a clone as much as possible to a Buffett Munger theory that you want to invest in the permanence company. Want to invest in businesses that will, last. Maybe a few generations. Nothing lasts for more. The history of business teaches us that in a 300-year continuum, every business goes failure. Munger often talks about Kodak.
Yes.
You could go to any emerging market, see a Kodak or a Coke sign, and Kodak is no longer in business. Not that photography has died down. Photography is exploded 100-fold, but Kodak died down on that. So being humble about that businesses don't last beyond that, but maybe can last 30, 50 years out there. So a large part of the portfolio is try to structure out there. But to answer your question more specifically, when do you sell out there? This is what I found, that if you find a superior investment opportunity, you sell. That makes logical sense to me. Whether it's superior or not, that's a very difficult question for you to decide, but that's one thing. But the one thing that I found that works, and which I will also try and implement in this bull run, first, all bull markets end badly, because you know that. There's no bull market that's a soft landing and everything continues out there. Stocks will be down 30, 50, 70% from that peak price whenever that happens out there. So when do you think, and there's some signs that come across that a bull market is ending, that's the time you want to get into cash, because you feel they're very extreme. That happens maybe 3-4 times in your lifetime. But when it gets that, you don't want to remain invested, because the market is going to fall 40-50%. It happened in 92, it happened in 2008. So there are periods when there are red flags waving at you that this market cannot sustain itself, it's overpriced. At that time, you probably wanted to get cash and sell. Other than that, you just ride it. My answer to people saying that, oh, my stock's down 20%, I didn't sell, I wish I had done. This is what I tell young people to do. I say that you have a 30-year career ahead of you, all right? So don't look at your career in one individual stock would be down 20% or up 15%, I don't know that. But overall, has your portfolio value doubled every 3 years? If it has doubled every 3 years, you're doing a good job. It's an aggregate, so it'll be stocks that you didn't sell the peak are down 20% or some stocks that are still climbing up, But broadly, given the India's growth rate, inflation rate, that's about 23-24% compounded. The Sensex over long periods give you 16%. You add another couple of points for dividend, You're not crossing that big a hurdle to get to 23-24%. But if you manage to double your money every 3 years, you're doing the right thing. Don't worry. Whatever strategy you're doing is good. The idea that you can get the tops of a stock or bottoms is, as well said, for fools and liars. It doesn't really happen. And good businesses take time. Sometimes they'll go through 2-3 periods of consolidation before they move the next leg up. And you just have to learn to deal with it. That is what market has taught us, that, when you buy something, you're not buying a stock or a squiggly movement on a chart or a price, but you're buying a part of a business, and you need to keep that business until the fundamentals of the business have changed.
Are there any stocks you've been holding on for more than 25 years in your portfolio?
Quite a few, Nikunj. I think Sundaram Finance would be one of them, Lever maybe for 20 years or so. I forget, but I'm in the happy state that, I let it compound, and I think I have a younger son who's more anxious, he's not performing. I try to calm him down. I said, look, this is the test. My portfolio doubling every 3 years. Broadly, if I'm doing the right job, I don't really care what's happening individually within a component stock. And that's what's been happening broadly, because India has given us that kind of opportunity. I'm not saying I've been a great stock picker, but I've been blessed because I've been in the right macro environment.
Was that your initial approach also, double your portfolio every 3 years? Whatever you get on top of that is a bonus. Should that be the approach also now for everybody?
It definitely should be the approach. Was it my approach at the beginning? No. I came upon it after a long period of thought and looking at how other people behaved and what kind of compounding you can do out there. But it's magical. If you can double your portfolio every 3 years, over a period of 30 years, your index, your wealth will go up 1000x. You do the math, it's actually amazing. Compound interest is not incorrectly said as the 8th wonder of the world. It's actually one of the more amazing things in life. Human mind thinks linearly, and we don't think in a log scale, and compound works in a log scale. So yes, I would strongly, strongly recommend people do that, because it's a way to financial freedom. If you can do that, you're home.
I remember one of your comments which has stayed with me, that a bull market can actually course your financial
It does,
life, and which
Nikunj,
actually
it's
does.
so obvious it does. It changes the course of your portfolio, the course of the country. It's like an eclipse. It's a miracle of modern finance. And when this bull market started in 2021 or when COVID, you know how badly hit we were and what we were thinking about ourselves and our portfolio out there. And already 2 years, 3 years into this has completely transformed our outlook, the feeling of a country, the feeling of a wealth. Outlook as me as a person has changed. So it is actually one of the more honest statements I made in my life, that no one understands what's happened once a bull market starts and once where it ends.
A couple of last follow-up questions. I'll shamelessly extend my appointment with you for another 5-7 minutes.
Sure.
What has changed between when you started versus now is the pace and speed of communication. The outcry system became demat, and demat trading has moved to mobile phone, and God knows where it is moving now. Because information is freely available and because information is widely discussed, how has that changed the cycles, and how has this changed the awareness and psychology of an investor?
People say that, but I think, more information is available. That doesn't mean necessarily more information is absorbed. I mean, people just still follow herd mentality. So I think people who have insight or can curate are still to be valued and to thought about. Original thinkers are still to be valued and thought about. People, what is that famous song that people looking without seeing and people, hearing without listening, whatever. So I think that's still true in the market. The follow-up to that question is that people say that the opportunities are more plentiful 40 years ago than they're today. And I find both to be wrong because, you look at last 10 years in America, the most dissected, discerning market in the world out there. You had companies like NVIDIA, you had companies like Apple, which Apple doubled the money of Buffett bought a few years back.
2014, I think.
Yeah, so many companies discovered, which are 10 baggers, Meta, Facebook, which are well known in the business, still grow up 5x, 10x. So how can you say that the opportunities are less? Opportunities are great. I think one of the beliefs of capitalism is that over the next 10 years, the kind of technology that are shaping our world will provide more opportunities, not less opportunities. So I remain quite optimistic about the future. Has it changed? Yeah, it's probably changed. I have more access to information. Getting a balance sheet was harder in my times, it's much easier now. It has changed, but that's still insight that is required to pick a great stock and the conviction required to hold a business is still fairly a rare commodity. And I don't think that's going to change. I think we will keep swinging between, fear and, optimism, and people who can take advantage of that will probably do well.
Yeah, I remember one of our common friends said that in 1980s, if you knew the share capital of a company, you'd done your research.
Yeah.
That was the level of information which was available.
Pretty much, it was that hard. You got a balance sheet. Someone gave me the balance sheet of a company and I made 100x money on that just because I happened to get the balance sheet at the right time. Yeah. That's all. It was so hard to get the data that time.
You've a lot of advice which is well appreciated by audience who's between 25 and 35. But there's also an audience, my age, nearing 50, nearing 60, at 60. They don't have 40 years of visibility in their life. What should they do?
I'll start with myself, then I'll try and broaden it out. I'm, on the wrong side of 60s, so I'm closer to 70 than I am to 60 now. So, take that. I'm 99% invested in the Indian stock market.
Now, I know equities.
Into equities, particularly equity. But
how much of your wealth is in equities? Percentage?
100%. The rest doesn't count. Okay. It actually is irrelevant to me. The house, the jewelry, whatever we might have. Actually, I never count that. My
asset allocation is 90% plus equities. Let me put it this way.
It will be closer to 95%. Wow. Believe me. But it's to me, I know, I understand it. I can deal with it. Even if it goes down 20%, I can deal with it. So I'm perhaps a special breed. I don't want to put my thing on other people out there. Because we are creatures of the market, we put all our money in the market. I don't have any FD, any cash, and real estate is only to live with, basically, never to invest. So it's worked out pretty fine for me. If you're old and not in the market, you need to put in some cash because you're entering the age, and particularly markets fall into swing 30%. What are you going to do? So, I don't know the right advice to do, but I can always tell the right advice for a young person. I'm very clear about that. There's no hemming, hawing, delaying it. Remain fully invested, ride out the tide, ride out the volatility. Risk is a permanent loss of capital. I don't see the situation happening in well-matched companies. It can happen in bad companies. So do that. But if you're 50, 60, yes, you need to be a bit more careful. I mean, I'm not the best example because I am basically from the market, so I understand the risk.
Okay.
But if you're 55, 60, yes, you need to get into a little bit FDs, take advantage of some high
Last
rates.
but one question, I'll flip it completely. Last time when we spoke, I spoke to you about a father giving advice to his son. We spoke about what advice you've given to your son. You got two lovely grandchildren, touch wood.
Yes, Veer and Anna. I got a shout out to them.
You told them that grandpa's coming on TV?
No, I haven't, but I make sure I leave my digital trail every time with them. I absolutely, I'm ridiculously happy being a grandfather.
Touch wood. But I'm sure as a grandfather, you're also doing what would be called as creating a nest egg for your grandchildren. And that is what could be the grandpapa's gift. How are you creating a nest egg for your grandchildren? They've got 50, 60 years ahead of them.
Absolutely, and I've realized the value of starting early. I mean, the compounding versus magic started early. And, I'll give you an example and bring it back to my grandchildren. Buffett bought Coke in 1989, 90, I think, and after he bought it, he made 10x money. Then for 15 years, the stock didn't move. It hit $45, and for 15 years, it remained between $30 and $45. For 15 years, the greatest stock picker in the world did not sell Coke. It always boggled my mind that for 15 years, the stock doesn't give you a return, and he didn't sell it. So I tried to investigate why he didn't sell it. And they realized that the dividends that he was getting was, a large percentage of his returns. He was getting, I think, currently he's getting about 60%. He put $1 billion into Coke in 1989, $1 billion, 25% of Berkshire's net worth into credit. And it went up 10x and then didn't appreciate. But he was getting $600 million a year back as dividends. Okay, so the cash flow from the investment was always there. So the longevity of that investment is made up by dividends and by capital appreciation. So I'm trying to do the same thing for my young children, grandchildren actually, that are starting early, putting in business that I think will last 10, 20 years out there. So maybe a real estate business, because we're always going to need real estate. Maybe some accessories business, because human beings will always want adornment with themselves. Business that I can see for 10, 20 years, and given my son straight instructions not to be sold. These are to be kept for my grandchildren, So, I think I can't recommend it highly enough. If you're young and you have children who are below 5 or 10 years, or you have grandchildren, as in my case, open a demat account and start investing for them. Your money will get clubbed with them in the capital gains. But try and buy stocks for 10, 20 years. And remember that until you sell it, there's no tax consequences. So money can grow unimpeded, compounding over long periods of time. And even if you compound every 5 years, you double your money, or 4 years, you double your money, they'll have a pretty good nest egg by the time they reach 25, 30.
How does your day start? How does your day end? Let's talk about it before we end this interview.
Well, I think my day starts like a normal day. I mean, I'm in desk by 9:50, 9:30 still. I really enjoy it, even though I'm closer to retirement age. I really still, I'm in love with the job I do. So, I just enjoy being in the office and looking at stocks and mentoring a lot of young people who come to my office. I have a whole bunch of them coming later today to meet me. So it's always fun out there. In the evening, it's, I used to go to CCI and hang out with my crowd. Increasingly, I'm spending time with my grandchildren because, it's just lovely to see these young children grow up and, the kind of questions they ask you and how they probe you. So I do that. I used to read a lot more, Nikunj. I'm sorry to say I don't read that much anymore because my eyesight has become a bit weaker and I enjoy a bit more of Netflix, I think, than I should.
Podcasts, maybe?
Yeah, podcast, Netflix.
Next time, let's plan one.
YouTube. Absolutely, Nikunj. So, a bit more of this thing, though. There still burns a regret within me that, we've been so inspired, Nikunj, I think, as you have covering Indian market for 30 years, and I have been a participant of the stories of Rakesh Jhunjhunwala, Nimesh Bhai, Rakesh, R.K. Damani, and all that they've accomplished in their life. And while theoretically you've done okay for yourself, you realize that you must measure yourself against the best in the business, And the best in the business, I realize, have a long way to go. And, they really, truly serve to inspire me, even today, to try and do my best.
So the best Ramesh Damani is yet to come.
I hope so, though I'm entering what they call if not the winter of my life, at least the fall of my life. So we'll see where I go. Nothing, I'm very happy. I led a great life. I have 2 ridiculously happy grandchildren. So I'm very thrilled with the way life's turned out. But I think like most people realize that could we have done better? We probably could have done better.
Well, Buffett's made 90% of his wealth, or 96% of his wealth after he turned 60. So
keeps me up, because absolutely. If I get that, I'll be very happy.
I appreciate it. I'm so nice of you to join us, and best wishes for our lovely year ahead.
Always nice to be on with you, Nikunj. Happy New Year to you and Happy New Year to all your team at ET and all your investors.
Thank you very much. With that, back to the studio.
It is the perfect bachelor